Hello, and thank you for lending your ears to Ratehub.ca's Real Money Talk podcast. In this show, we give you the real talk on all things money. We eliminate the fine print, we junk the jargon, and we explain how you can make smarter financial decisions. We're not millionaires, we're thousandaires, and we know you are too, so this show is for you. We want to talk about money because it affects everyone, rich and poor. Money shouldn't only be the occupation of the 1%, but rather the 99%. Money isn't everything, but it is everywhere. We want to educate about money through story. We Canadians ignore money, hoping if we do, like many other problems, it'll go away. Our goal is to make money an everyday discussion. Thank you for tuning in to Real Money Talk. Our guest host today is the Dragon Slayer, co-CEO and founder of Ratehub.ca, which brings you the Real Money Talk podcast. Welcome, Alyssa.
Thanks for having me. Great to be here today, Tyler.
Thanks for coming. And our special guest today on the show, we have Dan Bortolotti, otherwise known as the Canadian couch potato. No, he's not a guy sitting on his couch watching TV eating chips. He's a legend in the Canadian finance space. He's been a journalist and author for 20 plus years, writing for Money Sense since inception. Couch Potato only refers to the type of investing he perfected, and you can read about it on his blog or listen to his podcast to learn more. Since 2014, he's been a full-time advisor with PWL Capital. Wow, he's done a lot, and we're so excited to have him on the show today. Welcome, Dan.
Thanks so much for having me.
So we always kick things off with a money mistake or makeup. It's important to recognize that even financial advisors and CEOs aren't immune to financial mistakes. So what's a mistake you made in the last few weeks? I'm going to go first. I think now is the most important time to be supporting small businesses. And even though I saw, clothes for much cheaper elsewhere, I ended up supporting a small business in the neighborhood. Just ended up costing about 4 times as much. So instead of $50 for a new shirt and some underwear, I spent $200. But I hope it's going to be a really nice shirt. Alyssa, you got one?
Yeah, so I've been trying to find things on Facebook Marketplace. It's a great way to get gently used items and to not worry about shipping times right now during COVID. So I saw a bike trailer that was posted that I could take my 2 little boys around in, and I jumped on the first one I saw. And I think I overpaid and saw a few days later the best brand, the Thule, came on sale for $375, and I paid over $400 for an inferior one. So not the end of the world, but that would be my most recent mistake.
Saving the environment a little bit at the time, I guess.
Yeah, that's true.
And Dan, yourself?
Well, despite your introduction, Tyler, I have actually spent a fair bit of time sitting on the couch watching TV and eating chips these days. And I would say in terms of excessive spending during this time, for me, it's been home delivery of wine and food. I have been doing more cooking than I normally do, so I'm trying to make up for it. But there's definitely been a few too many home deliveries.
I have two questions there. What's your favorite bag of chips and your favorite bottle of wine?
Are you asking me for a specific pairing, or can I answer that separately?
Independent.
So for chips, I'm a Doritos, I would say, would be mine. Although I do like a plain salty Ruffles as well.
Touche.
Yeah, which can be paired really nicely with any sparkling wine.
Okay.
I'm just wondering if he gets Dorito fingers on the wine glass, though.
No, you got to use separate hands.
Oh, okay.
For me, I'm really into Ruffles sour cream and onion.
Nice.
To be paired with my Netflix guilty pleasure of Selling Sunset Season 2. And wine, I can never resist a nice cab from Napa.
Very nice. I bought the Revel cider, actually, to try and cut back on the wine drinking. So Revel cider is at a Guelph, and you got to buy a 6-pack, but it's basically a 750 ml bottle of cider, and it's only like 7.5%. So I was like, okay, well, I feel a little bit better about drinking this than throwing back bottles all the time. My chip, though, is a barbecue Lay's. I'm kind of a diehard on that one.
Well, it sounds like we have a diversified portfolio of snack foods here. So
perfect. Dan, the Canadian Couch Potato blog and podcast are mentioned in a lot of the Facebook groups that I follow on financial advice. And the podcast and the blog still hold up. They're still full of valuable information. Why is that? And what does it say about the finance industry? And are people overthinking their finances?
Yeah, no, it's an interesting point that you bring up because I started the blog about 10 years ago now. And when I go back and I read some of the older articles on the blog, not all of them hold up. I mean, there's a lot has changed in the industry over the years, mostly for the better. I think the plight of investors 10 years ago was worse than it is now. There are a lot more excellent options available for people who want to be do-it-yourself investors. There's cheaper funds, there's lower commissions on trading and things like that. So a lot of those articles are mercifully out of date because I would be a little bit upset if they were, if those problems had not been solved, but many of them have. But I think the articles that do hold up over time, the evergreen stuff is really about behavior and about discipline and about sticking to a long-term strategy, which is always good advice and is always a challenge, right? I feel like we have solved a lot of the practical problems around investing. I mean, 10 years ago, I could say, look, I wish there was an ETF or an index fund, that met this need, but nobody's created one, or whatever exists is still too expensive. That's not the case anymore, right? All the products exist. You can buy them with no commissions. So all of those kind of logistical things have been solved. But the perennial problem for all investors is just getting your head around the fact that you cannot predict the future. You are not going to outsmart the market. You need to diversify rather than making big risky bets. And all of those things, I think, are always going to be a challenge because it's part of being human. And so the articles that kind of address those questions, I think, are going to have a long-lasting appeal.
Definitely. When did Robo-Advisors start?
Be about 6 or 7 years ago, the first one started to appear.
Do you think is it easier now for people just because of services like that?
Yes, I would say robo-advisors are definitely part of the positive steps that we've taken. One of the challenges previously with being a do-it-yourself investor was, how do you build a diversified portfolio if you don't really know, what the components should be, what the proportions of each of those components should make up, which funds do you choose, how much risk, is appropriate for your situation. When you had to build a portfolio yourself from scratch, those were difficult obstacles. Now with robo-advisors and also with some of the balanced funds that have come out, so you can purchase now, for example, a single ETF that contains an entire balanced portfolio of stocks and bonds in one product. The fact that these are now widely available makes the portfolio construction a lot easier than it used to be, right? So if you're just starting out as a new investor, you've got $5,000 in a TFSA, you don't really know where to begin, purchasing one of these funds or signing up with a robo-advisor allows you to build a very sophisticated, very well-diversified, and very low-cost portfolio without having to be an expert in portfolio construction. So that's something that just didn't exist 10 years ago. And so that part of the problem, I feel like, has been mostly solved. If people could get their heads around that, that's all they need to do. I mean, we all have a tendency, I think, to overcomplicate investing. One of the challenges that I have encountered since the appearance of some of these easy solutions is people saying it can't be that simple, right? And this is especially true for people who have more money, people who have maybe a couple of $100,000 to invest, are saying, I need something much more customized. I need something much more sophisticated, than a single ETF that holds stocks and bonds. Or that a robo-advisor, it's fine for most of my portfolio, but I also have to do something else on the side. And I wish I could get it through to people that, no, this is all you need, right? This is much more sophisticated once you pop the hood than the vast majority of portfolios that people hold. Just because it's simple doesn't mean it's simplistic. And I think that that's an important distinction that has not really sunk in with people yet. We love complicated solutions. We love making things more difficult than they need to be. And that's one of the perennial problems, I think, that faces do-it-yourself investors.
Yeah. My burning question is, what should my strategy be for my RSPs and investments in the stock market right now? I'm not a market timer, but this has been a really bad drop. And are things really going to come back this time? And how long do you think myself and others who are holding out will have to wait?
Well, I certainly can't make any predictions about, how long the market will take to recover its former high. But I will say, just to comment on what you said, it's so common to hear people say, I'm not a market timer, but. And as soon as you say, but, you usually follow that with a statement that suggests you're trying to
But
time
I'm
the market.
going to be a market timer.
And so it's really common, right? Like they'll say things like, I know you can't predict the future, but what do you think is going to happen in the future? And I understand the temptation. So I'll try to be as constructive as possible with a question about, if you have money to invest in an RSP, what should you do now? Always consider your time horizon. The fact that you're putting money into an RSP suggests that it is money that you will need when you retire. And, as long as you are 5 to 10 years from retirement or more, right, it's not really that important what the market conditions are today. All you want to be conscious of is the money I'm investing today, do I have a reasonable expectation that it will be worth more when I need that money in retirement? And I think it's fair to say during, before, or after any market crash, money that you don't need for 5 to 10 years is likely to be invested in stocks wisely, right? I mean, it would be great if we could pick the best times to invest and only to buy when stocks are low and are expected to rebound. But always remember that the best time to invest is only known in hindsight, right? We don't know what's coming ahead, but I mean, we're having this conversation in late May. Right now, I mean, at least looking back, right, the bottom of the market was kind of mid to late March. And the quote unquote best time to buy, might turn out to have been late March. But remember what things were like in late March. It's easy for us to look back and say, oh, well, we knew the market was going to rebound. In March, people were wondering whether the entire economy was going to collapse. People were worried literally about contracting a deadly illness if they went outside. Nobody thought it was a good time to invest. Well, I shouldn't say that. Some people, I suppose, did. But you always have to remember that the quote unquote best time to invest is usually a time when it doesn't feel like a good time to invest. And so I always try to reframe it and say, listen, the best time to invest is when you have the money and you have a plan. If that's the case, then, as long as you're still employed and you have some surplus income, you should continue with your investment plan regardless of market conditions. You don't stop contributing because you think the market is overvalued. You don't stop contributing because you think that next week we're going to have a market crash. You just keep adding the money as you can afford it, as long as you have a long-term plan. And we know that in the vast majority of cases, that's going to work out in the long run. But it's easier said than done.
It's true. I know. I think it's always been a strategy that I thought was very easy to follow until you put it to the test and live through a once in 100-year pandemic.
Mm-hmm. No, it's true. And remember that, there will always be people too who will look at these situations and say, oh, I saw it coming, or we knew there was going to be a crash. And nobody knows. And I can say with confidence that almost nobody predicted that the cause of the next crash was going to be something like this, right?
Yes,
yes,
agreed.
in a vague way, people have been talking about the possibility of a global pandemic. That's fine. But that wasn't at all helpful in helping you come up with an investment plan, right?
Agreed.
So whenever people say this time it's different, it is always different. The reasons are always different. The specifics are always different. But in the big picture, what stays consistent is we can't predict the future, and trying to exploit that with your investment strategy is futile.
I think I think too, one of the things that I forget about is by automating my investments through Simple, the robo-advisor I use, and through RateHub's group RRSP, I am taking advantage of dollar cost averaging when I'm purchasing. And so I probably don't take that into account either, that by doing that, I'm naturally buying some of my investment holdings at lower points. So I was still, by having that part automated, I was still making those purchases when the market was down. Now that's not all of my portfolio, but it helps.
That's right. I mean, and that's why if you have a strategy that involves regular contributions, you have sort of built in a strategy for buying low, right? So, I mean, for example, we have the same issue with our clients here. They send money from time to time to invest, whether it's a couple of lump sums a year or they have a monthly contribution. And when that cash arrives, it's interesting because sometimes, clients will say to us, I'm going to send you $10,000 to invest. What do you think would be the right place to put it into these days? And I think what they mean is, which asset class do you think is going to be most likely to be the best performer over the short term? And my answer to that is always, I'm going to look at your investment plan. I'm going to see whatever asset class is furthest below its target, and we're going to put the money there. There's no decision making involved. Once you have a long-term plan, if your goal is 60% stocks and 40% bonds, you send some new money and your portfolio is at 58% stocks, I'm going to add it to stocks. If it's 62% stocks, I'm going to add it to bonds and get you closer to the target. And as simple as that seems, it removes all the emotion from the decision making, and it guarantees that you are buying whatever is, furthest below the target. Doesn't necessarily mean that it's going to lead to higher returns over the long run, but it does build in a very disciplined process that removes the emotional decision making. And, emotional decision making is the biggest enemy of investment.
Some wise words. I really like it. My thing, I'm not an investor at all, and I'm just happy to have the robo-advisors because I always thought, I need to get a portfolio and I need to get, and someone's like, well, do you have a TFSA? I said, yeah. Do you have an RSP? Yeah. Well, that's your portfolio. Oh. So that was my big learning curve. And now, just automate the investing or automate the, the money just goes away as soon as the money gets deposited into my account. And now things are working out.
So that's a big part of it too, right? And that's why I always recommend automating investing, because it's very easy to, say you're going to spend what you need and whatever's left at the end of the month or the end of the year, is going to be what goes into savings. And the fact is we're all inclined to spend whatever's in our bank account. And so if you take the savings off the top, you're far more likely to grow your money over time. And if you remove the decision making every time, like if every time you put money into the market, it's a decision about what I should buy, it is so difficult to be a successful investor, right? Because you're making so many decisions, none of which you can be reasonably confident will be good, right? Because most of them will be emotional. Most of them will be based on whatever's happening in the market now or has happened in the last week or two. And all of that noise that you're hearing is just a distraction. And so the more you can automate, the more you can stick to something disciplined and boring, the more likely you will have a better long-term outcome.
So Dan, my next question for you is about my own financial literacy and how my husband and I are doing. So I often wonder if I'm holding my investments in the right things. And I guess to your earlier point, it just seems so simple that I think it can't be this easy. What am I missing? And so am I missing anything? Is the investments that you hold, is that the most important part of a financial plan? How do I know if we're on the right track?
So are you talking about just the kind of the mix of various investments that you hold within your accounts?
Yeah, and I guess, so, I think many Canadians know as much as possible, the first step is to, after you pay off your debts, get as much invested in your registered accounts. Once we've got money in our registered accounts, what types of investments should we hold?
Well, I mean, as you probably know from my work, I'm an advocate of using really broadly based, low cost index funds. So for people who may not be familiar with the term, an index fund is a type of mutual fund or a type of exchange traded fund or ETF that holds a whole portfolio of stocks and bonds. So the best index funds, in my opinion, are the ones that represent, entire markets. So if you purchase an index fund that holds Canadian stocks, it holds virtually all the stocks that trade on the Toronto Stock Exchange in proportion. So the larger companies take up a bigger share of the fund, and you can get similar index funds for U.S. stocks and for international stocks. By doing that, you allow yourself to have very, very broad diversification, even with a relatively small amount of money. So if, for example, you're just getting started in investing and you've only got a few $1,000s, it's very, very hard to build a diversified portfolio any other way. You're not going to buy individual stocks. You're not going to buy individual bonds. So by using these diversified funds, you can get access to a huge amount of the world's stock and bond markets with just a very small number of holdings. But then I think that the next big question is to determine what mix of risky stocks and safer bonds that you want to hold in the portfolio. And that's really, in many ways, one of the most important questions to address when you're building a portfolio, because it's going to be the biggest determinant of your long-term performance, right? Somebody who invests 100% in stocks versus somebody who invests 100% in bonds is going to have a very, very different experience. They're likely to have a very different rate of return over time, and they're certainly going to have a lot more or less volatility, more ups and downs in the swings of that portfolio. It's really a risk reward trade-off. A portfolio that's more heavily weighted to stocks is likely to have a higher expected return, but it's going to be a very bumpy ride. And a portfolio that's, cash, bonds, GICs is likely to give you a very smooth ride, but it's also likely to give you a pretty low expected return. It's hard to figure that out. There's some rules of thumb. Sometimes you hear people say that your allocation to bonds should be roughly equal to your age. So if you're 40 years old, you should be 40% bonds and 60% stocks. That's an okay rule of thumb. It gets to the main point, which is that as you get older, your portfolio should get more conservative, but it's a bit too simplistic. And I think that you need to consider your own personal comfort level with stocks too. So for example, you could argue that a person in their 20s, can afford to take a lot of risk and hold a portfolio that's 80 to 100% stocks. And in theory, that might be all right if you're Rip Van Winkle and can go to sleep and wake up 50 years later and look at your portfolio, it would be fine. But I know from experience that a lot of young investors dramatically overestimate their risk tolerance and they put too much in stocks. And when we go through a downturn like we did in March of this year, the market fell over 30% in a matter of a week and a half. That is gut-wrenching. And if you're new to investing, the idea of losing a third of your money in a week or two is just enough to put you off investing forever, or at least for a very long time. So it's really important for you to try to understand what your tolerance for risk is. And it's hard to know unless you've been through it. The analogy I like to use is it's fine to fly a flight simulator, but it's not quite the same as being in an airplane that's about to crash. So right. You really have to, the questionnaires are great. The hypothetical questions are great. But my rule of thumb is unless you've lost a big chunk of money in the stock market and you can handle it, err on the side of conservative and look for a portfolio that is a little bit more weighted to bonds until you've got your feet wet.
That makes sense. And that's super helpful, Dan. Thanks.
I have a bit of an interesting question. And again, this is where your name sort of comes up in a lot of these different Facebook groups that I'm on. What do you think of financial independence, retire early, or the FIRE movement? When I read blogs that associated with FIRE, I feel I need to live on rice and peas and save $1 million before I retire. And I am nowhere near that. So I just,
it's a movement that's been getting a lot of press, certainly online and amongst certain groups of people. And my sense is it means very different things for different people. And to kind of paint it all with the same brush seems inappropriate. So, I mean, I'll tell you right out the bat, I find it very hard to identify with it because I have no interest in retiring. And I love to work, and I want to do it as long as I'm good at it and as long as I'm productive. So on a personal level, I find it difficult to relate to the idea of kind of retiring in your 30s. And I don't know what you do after that. I mean, that's kind of my biggest question is, what do you mean by retire? So a lot of people, I think, when they say this, they are working in jobs that they don't like, and they're looking for some kind of escape from that, which is really hard to blame people, right? I mean, if you're in a job that, pays really well, but is soul destroying, it's hard to blame people for wanting to get out of that and wanting to, say, spend more time with their kids or travel or any of these things. The question, of course, becomes, how do you possibly finance that, right? And this idea that you'll work like a dog until you're 37, 38 years old, and then, defer all enjoyment until that point. That doesn't make a lot of sense to me, because I think, when you're young, that's when you should be enjoying a little bit of work-life balance and enjoying a lot of things that you may not be able to do a little later on in life. I also really wonder if people have thought through the consequences of it, because if you retire, let's say in your 30s or 40s, you've got to look forward to at least 40 to 50 years of living off whatever you've saved. And as you said, I mean, unless you want to eat rice and peas for the rest of your life, I find it really hard to imagine a lifestyle like that. It doesn't appeal to me. I would rather sort of find some balance and, work until I'm in my 60s, and then be able to enjoy a more comfortable retirement. But I mean, I'm not here to judge anybody who wants to do it. I just feel like it's really important that whatever decision you make, A, you've thought it through and you understand the financial implications of it, and B, that you don't judge other people for making different decisions. I mean, it's so common, I find, in the online world now to shame people and to be hyper judgmental about other people's choices. And I don't think any of that is helpful. People have different priorities, people have different motivations, and we all need to respect that. As long as your goals are realistic and you're willing to put the work in to achieve them, more power to you.
Right. So I have some money with my Robo-Advisor. I have some, different money in different places. I have 2 kids at home. I have a mortgage. Do I need a financial planner or an investment advisor? And if you just wanted to touch on the differences between them.
So that's a really good distinction, I think, that a lot of people don't understand. I think among the general public, and even sometimes in the media, the terms, or the term financial advisor is used in a kind of non-specific way. There is definitely an important difference between a financial planner and an investment advisor. I mean, it's a regulatory thing as well, but even without getting technical about it, an investment advisor, as the name suggests, simply, can advise you on what types of investments to purchase in your accounts. A financial planner does a lot more. And in fact, they normally don't give you investment advice per se. They're not going to tell you buy this fund or that fund. A financial planner is going to look at a lot more of the big picture things in your life. If you have some surplus money at the end of the month, what's the best way to deploy that? Should you be paying off debt? Should you be investing? Do you have an adequate emergency fund? Is your spending out of control? Do we need to, look at your cash flow and say, you need to make some changes to your habits in order to get ahead financially? It's tax planning, right? It's all sorts of things that, fall well beyond the scope of what to buy in your portfolio. I would say that for the majority of people who do not have large portfolios, so I'm saying, like, unless you've got, a minimum 6-figure portfolio, you probably don't need investment advice as long as you can bring yourself to do, one of the easy solutions. So either A, open an account with a robo-advisor, or B, if you are a little bit more keen on doing it yourself, opening an account with a online brokerage and purchasing an ETF. That's kind of the easy part. What is not easy is having a financial plan in place. And, I see it a fair bit, talking to people, and they have a lot of money, say, in a taxable account, and they have a mortgage. And I say to them, well, why don't, instead of having all that money sitting there earning next to nothing, and you have a mortgage at 2.8%, why don't you put that cash against the mortgage, reduce your debt a little bit? Why are you contributing to a TFSA when you're in the highest tax bracket, and an RSP would be more appropriate, right? Why are you, for example, you have two spouses who have very different levels of income. Maybe you should use a spousal RSP in order to get some tax advantage, some income splitting there. These are all things that are not about investment. They're about planning. And most people, I would say in many ways, the financial planning picture is harder, especially if you agree with the investment strategy that I've always advocated, which is an indexing passive strategy. You don't need to necessarily know very much about the specifics of the market. You just need to be able to know how to purchase a diversified portfolio, which is not that hard to do and is easy to find information online. Financial planning is a lot more complicated. There's way more moving parts. It's way more individualistic. Like I would say, to the two of you guys, you could probably build a portfolio that's almost exactly the same. It might be appropriate for both of you, adjusting for risk level maybe, but your financial plans are going to be completely different. And so I am really a big fan of the model of hiring a financial planner who, unlike investment advisors, will often, work for a flat fee or an hourly fee. You don't need to pay them an ongoing annual fee. Hire a financial planner to do some work for you when you're at a transition stage in your life, say, and then look after the investment piece on your own. So that is much, much more cost effective than having an advisor do both of those things for you. And for the clients we work with, we're working with people, average account size is somewhere in the ballpark of 1.5 million. So that's a little different situation. People who have money like that have more complex situations, and they need somebody to look after both the plan and the investments. But for most Canadians, that's just not the case. And even if they wanted to, they don't have access to that information. This is really one of my big frustrations with the industry. If you've got $50,000 or $100,000 to invest, and you want, a good quality financial advisor who's going to put you in low cost funds and give you some planning advice, good luck. You have a very, very difficult time finding that. Most of the low cost advisors who do, comprehensive planning at a reasonable fee have minimum account sizes of at least $500,000, very often more than that. And that excludes the vast majority of people. Right. And so it leaves everybody else with a pretty tough decision. And that is, what do I do if I need advice? And that's why I'm saying that, to hire a financial planner from time to time when you need that advice, and then to look at the investing piece on your own if you can manage it, that's a pretty good, accessible combination for people who have more modest sums to invest. And that's why I've spent so much time creating free resources for people online for do-it-yourself investors, because there's this gigantic service gap, right? And that, people will call me and say, look, I would like to work with you, but I don't meet your minimum. What do you recommend? And all I can say is try to put in some effort to learn to do it on your own. And a big part of that is not overcomplicating it. Accept some simple options that are available. And if you need a planner, then get some fee-based financial planning advice independently.
Awesome. Great answer. Thank you.
Yeah, definitely. So Dan, my next question is, if you had one wish for your children's financial future, what would it be?
A defined benefit pension plan. So I hope they both become public servants and have a gold-plated pension plan. No, I really hope that, as I said earlier, the options available to people now are much better than they were 10 years ago. And I think they will continue to get better. And I look forward to a day like, when my kids have more money to invest, that some of these old school ideas will have disappeared. This idea that you've got to hire someone to pick stocks for you and that you have to hire a fortune teller to predict where the economy's headed, and that there will just be simple, low cost, easy to manage options available for everybody. We're already mostly there in the US. I mean, the US has so much better options available to small investors than we do here in Canada. We're many years behind them in many ways. And so I hope some of those positive things will be available in Canada by the time they're able to sock away some more money.
So, Dan, this is a special one for me, but for fans of your podcast that miss you terribly and want more, do you have any bad financial advice you've read recently?
Yeah, the bad investment advice segment used to be pretty popular on the podcast, and funnily enough, it was not difficult to find bad advice out there to tear apart. If I was doing a new episode of the podcast now, I think one of the ones I would jump on is that a market downturn is the time to become a stock picker. This is an idea that I have to say I was pretty surprised by it, because after the crash in March, there was, basically everything went down. And people looked at it and said, maybe there's an opportunity here. The entire stock market seemed to fall, in unison, but there must be some good companies out there that are going to profit from this situation, or at least not be hurt as much as others. And so maybe it makes sense now, instead of being a disciplined index investor who, diversifies and acknowledges that we can't pick stocks, now's the time to start picking individual companies that are going to thrive in this new environment. And I heard this from a remarkable number of people, including a few clients who never mentioned this to me before. And I don't really understand why all of a sudden the rules have changed, right? Just because we were in a crisis doesn't necessarily, it doesn't mean that it's any easier to identify which companies are going to outperform in the future. And so, people were saying things like, I'm going to start adding some individual stocks to my portfolio because, Air Canada, it fell, but the government's not going to let it fail. So it's definitely going to recover, right? Or, Costco and Amazon and Netflix are all companies that are going to profit from this new reality. And, my response is the same as always. The market already knows everything you just said. This is not any unique insight that only you have. And if the market knows what you know, then it's priced in. And so the only way to profit from that kind of insight is if you're the only one who has it. And of course, you're not the only one who has thought about those things. So, the advice is it's always a loser's game to try to pick individual stocks. And that doesn't change whether the market is unusually high or unusually low.
Awesome. Thank you very much for that. I might even steal the bad investment advice.
Okay, but you have to do it on your own because it's copyrighted.
Okay. If it's okay with you, we'll jump into the rapid fire questions.
I'm intimidated by this, but I will do my best.
Okay, Dan, what is in your wallet?
I have a George Costanza wallet. For those who don't get the reference, it's got a little bit of everything. Actually, I'm joking because I used to have a wallet like that. I have streamlined. I keep a debit card, a credit card, and my ID and nothing else. I don't even carry cash anymore.
What credit card?
I can't say that.
What book do you think everyone should read?
Does it have to be an investing book?
Nope.
What book? I am a voracious consumer of audiobooks these days. It's been a long time since I read a hard copy book, but let me think about, I would say, and I'm not going to put this in a category of, oh, you know what? I just did think of a book that I think everyone should read because it's sort of an investing book, but it has way more application. And that is Thinking Fast and Slow by Daniel Kahneman. For people who don't know him, Kahneman is a Nobel Prize winner in economics, but he's not an economist. He's a psychologist. And his book is about all the various obstacles that we have when it comes to rational thinking and the way our brains work in different ways. And there are some long sections on investing, or at least how we think about money, that are hugely useful. But in my old age, I've come to understand that the best way to become a good investor is to understand how we think, our cognitive biases, our the sort of mental shortcuts that we all use, the struggle that we have to do things like evaluate risk properly. And this is the best book, I think, on that subject. I've read it twice now, and I would say it rewards 2 or 3 readings.
I got to add that to the bookshelf. Yeah. Sounds pretty interesting.
The next question for you, Dan, is where do you spend most of your money each week?
So not so much these days, but my weakness is definitely eating out. I really enjoy, I live downtown, and so there's no shortage of great restaurants, at least in the pre-COVID era. And that's one of the things that I really enjoy doing. And it is definitely a habit that can add up quickly. So a fair bit of my disposable income goes to eating out.
What's your favorite restaurant in Toronto?
I've got a few. I love Momofuku, which makes probably the best ramen that we've had. Got a great little Italian place near us called Charisma, which is down in the financial district. And I would say that those two kind of Italian, you can never go wrong. And find a good place, whether it's Chinese or Thai, or Japanese, are all my favorites.
I love that. If you had one tweet, 280 characters, that everyone in the world was guaranteed to read, what would it say?
I'm going to deflect this one with a story because I will say last week I shut down my Twitter feed. I had close to 11 or 12,000 followers, but I didn't tweet very often. And I shut it down because I'm finding that this kind of quick hit social media is such a huge distraction. And I'm going beyond investing here. Because I set up my Twitter feed, with the name Canadian Couch Potato, not with me personally, I only followed, people whose investment commentary I thought would be interesting. And still, my feed was overrun with COVID news, Donald Trump, all sorts of distracting things that had nothing at all to do with what I, was trying to do with Twitter. I just find that I'm trying to streamline my life these days, and a big part of consuming information is blocking information, curating it, trying to be really thoughtful about what you consume and what you don't. I deleted the news feed on my iPhone for that reason as well. And now I only seek out certain news feeds that, I just feel are more relevant. I just find, maybe I'm just officially become a grumpy old man, but I find that the more and more information I'm overloaded with, the worse I feel, and the less comfortable I am, the less confident I am with my decisions. And so I've made a conscious effort to tune a lot of that out.
That's big. Yeah. Do you think you'll come back to Twitter or no?
Possibly. I don't know. I'd be starting from scratch now.
Yeah.
So, but it wasn't really done on a whim. It was something I've been thinking about for a while. And, as I said, I'm trying to, listen to a lot fewer things and read more deeply rather than more widely. And that was just kind of one step in that direction.
You dodged my question, so I'm gonna ask it in a different way.
Okay.
This is the way I used to ask it, but it was if you had a sign on the side of the Gardner Expressway, that a billboard, what would you want everyone to know? And it doesn't have to. It's just it could be like a money motto, but it could also just be like generic life advice.
Yeah, and the fact that it's on the side of the road is probably fitting, like to extend that metaphor. It's like, keep your eyes on the road and always be aware of where you're headed, right? You don't know every twist and turn on the road ahead of you, and that's okay, as long as you know what the destination is and you can keep your focus on that. The route might change. You might hit some traffic along the way. You might hit a couple of potholes. But as long as you know where you're going, you'll get there eventually.
Okay. I accept that answer. Thank you.
Dan, what's your number? What do you need to live comfortable and be independently wealthy on your own terms?
Wow, that is an impossible question to answer. And I don't say that to be evasive. I will try to be a little bit more specific with that, because it's a question I get from clients a lot too. And it's really amazing to appreciate people's different expectations. So, for example, I have some clients who have, very large seven-figure portfolios and wonder whether that will be enough to retire on, even if they work into their late 60s. And I have others who have only a fraction of that and consider themselves extremely fortunate and well off and are happy as can be, on a very small monthly income. It has everything to do with what you're used to, what your expectations are, where you live, frankly, makes a big difference too. This idea that there is a number out there is maybe one of the obstacles in smart retirement planning, right? Because I think a lot of people will, you hear people throw around the number $1 million all the time just because it's a nice round figure. And so many people think, I'll never be able to save that much. And so I'm not even going to bother trying, right? It's a lost cause. I think if you look at what Canadians actually retire with, I don't know what the average portfolio size of a client on the day of retirement is, but I have to guess it's a pretty modest 6-figure number, a couple of $100,000 perhaps. And that's within the reach of a lot of working people. And it's not enough necessarily to live high on the hog, but if you've been living your whole life pre-retirement, with a modest sort of average or median income, you don't need $1 million to retire comfortably. You need to, enough to generate roughly the same amount of after-tax income you enjoyed while you were working. And once you factor in Canada Pension Plan and old age security and your savings, that might not be as difficult as you think. So it's another argument for, having a financial planner run those numbers so you can find out what your number is, because I guarantee you it's going to be different from the people around you. And it's certainly going to be different from the people that you read about, whether it's in the paper or on blogs. I mean, we talked about the FIRE movement, right? I mean, for those people, what's the number? Like, if you're going to retire at age 40, you better have a 7-figure portfolio or very, very low income expectations. And if you spend $150,000 a year, well, you're going to need a lot more too, right? But I think that number is very personal, and it is worth, doing a little bit of work to figure out what it is for you.
You answered like so many of my other questions with that. I didn't have any more questions, but just in my own head, I have a bunch. And so that was a phenomenal answer.
Well, I hope my rambling managed to answer all of your questions. But
yeah, well, because, going back to the FIRE thing, where like those guys, apparently it's the trick is $1 million and you pull out 4% a year.
Yeah.
And you live on that. And they do all kinds of things like, well, what you said, they do geographic arbitrage where they'll live in Thailand because it's much cheaper to live in Thailand. Yeah. And, so, but yeah, anyway.
Which might be true. But again, like that's obviously not a retirement formula for everybody. So,
and I feel much more comfortable with, like, I keep on looking at my, the projections, and I'm like, I do not have enough going into my savings. But yeah,
but hardly anybody feels that, right? And I think you have to remember too. One of the things I try to stress, especially talking with younger people and people with young families and mortgages, is your priorities change over time, right? And your goal should be to try to increase your net worth every year. And increasing your net worth can come in different ways, right? One is saving and investing, but paying down your mortgage also increases your net worth. And, there just aren't that many people who in the early years of their career, or frankly, even in mid-career, can raise kids, pay down a mortgage, max their RRSPs, and do everything else that they want to, right? I mean, there's just not enough money to go around. So try to get over this idea that you have to do everything and just do a bunch of things right and try to avoid the big mistakes. And in the end, that's usually going to work out for you.
Awesome. So for people that want more of your advice or for further questions, or if you wanted to plug anything, now is the time to do that.
Well, I don't really have much to plug these days anymore. I have kind of gone offline. Well, I don't want to say gone offline a bit, but I'm not generating nearly as much new content as as I have in the past. My website, CanadianCouchPotato.com, is still active. You're more than welcome to visit it. I do still read all the comments, and as best I can, I try to answer them. So that is probably the best place to tune in if you're looking for more.
Thank you so much, Dan, for being on the show. I've learned a lot.
It's been my pleasure. Thank you for having me.
And Dan, I just wanted to echo, always love chatting with you and catching up with you. And every time I chat with you, I always walk away feeling more relieved and like there isn't a silver bullet or this easy way and perfect way to manage money. I think it's just trying to save as much as you can, put away money when you can, and do it responsibly and simple. And it isn't sexy, and it is simple if you follow the plan.
It's
so
true.
I'll have a better sleep tonight, and thank you.
You're welcome. Thank you.
And now it's time to take a withdrawal from the knowledge bank. What you might not know about home insurance. First, you don't need it. But since you probably have a mortgage, your lender requires you to have insurance. It's also true of a condo board and even most landlords. All that said, though, it's just a smart idea in case you do have a major incident like a flood or fire. So for tenants, you might be able to get away without insurance, but don't expect your landlord's insurance to cover your stuff. If you live in a basement and a pipe bursts, your landlord's insurance will pay for the repairs to the unit, but not your belongings. For anyone to protect their belongings, from TVs to couches, you need your own insurance. In fact, you might not know it, but if someone steals your laptop from your car, it's not car insurance that will help. It's your home insurance that will pay to replace the stolen laptop. But there are limits to anything you own. Your 5-year-old laptop depreciates in value, so you might only get half of what you paid for it. If you have special jewelry, rare art, or even a fancy bicycle, your home insurance may pay back $1,000 or $2,000 of it. So if you need more coverage, call your provider to up the limits. Also know that your 5-year-old laptop can be replaced with a brand new laptop if you have a replacement cost policy. But it costs more, and you do have to specifically request replacement cost on your policy. A typical home insurance policy comes with what's called actual cost value. Actual cost value will include depreciation into anything you own, so don't expect a windfall. Of course, without an accurate inventory of your contents and valuables, neither you nor your home insurer knows what anything is worth, and best guesses come into play. So make sure you do an inventory of your stuff and their worth. Even better if you have receipts, and yes, there are apps that do that for you. On the topic of value, know that your home is not valued at market value, but rather the rebuilding cost. It's much cheaper that way, but if you've renovated and upgraded, be sure to inform your insurer because they need to make sure you're covered for those upgrades. You also need to understand your policy and how you're covered. I see people online complaining their insurance company didn't cover them for a specific claim. Well, there are reasons for it and ways to protect yourself against them, the most important of which is to read your policy. For example, did you know that floods now surpass fire as the costliest home insurance claim? Here's what you need to know. Your comprehensive home insurance policy typically only covers floods from a burst pipe. Unless you add an endorsement to your policy, you aren't usually covered for a sewer backing up into your house or a river overflowing into your basement or even melting snow getting inside. Those are different types of risks and charge an extra premium. There are other ways of protecting yourself from those risks, like a sewer backup valve or ensuring you have a weeping tile and waterproofing around your home, but unless you have the endorsements, don't expect your insurer to pay out the claim. There are some things they will cover, like damage from lightning, hailstorms, and wildfires, but without endorsements, they won't cover your landslides or earthquakes. Other warnings. If you're renovating your house, inform your home insurer they want to add additional coverage due to increased risk. Traveling the world and away for more than 30 days? Inform your home insurance provider. If you're not there, it increases the risks of break-ins or flood damage going unnoticed, or even a fire breaking out by a faulty appliance. Failure to do so, and they can deny your claim. Let's talk for a minute about home insurance and its costs. Bundling with your car insurance can save you money. Paying annually can save you money. Installing a monitor burglar alarm can save you money, but no, the doorbell cameras don't count. At least not yet. Car insurance providers usually check your credit, but not so with home insurers. Allowing your home insurance provider to check your credit may result in cheaper rates. Of course, the best way to get cheap home insurance is to compare quotes online. You can do that at Ratehub.ca for free in 5 to 10 minutes, even if it's just to make sure you're paying the best price. Happy shopping! Thank you for listening. Thank you to Beat Chemist for providing us with our music. Find him on SoundCloud. I want to sincerely thank you for taking the time out of your own day and investing it in yourself to get smarter about money. Head over to Ratehub.ca to learn more about making smarter financial decisions. If you want to thank us, please leave a review on Apple Podcast and follow us on Spotify. Thank you for listening. Let's help Canadians choose better with their finances.
The views expressed by guests are their own, and their appearance on the program does not imply an endorsement of them or any entity they represent. The views and opinions expressed by Ratehub employees are those of the employees and do not necessarily reflect the views of Ratehub Inc. or any of its sponsors or officials. This is for general use. We're not certified or licensed advisors.
Yeah, we just don't want to get sued.